Good morning, good afternoon, good evening, folks. Michael Zuber, one rental at a time. It is Thursday morning, and that means we bring on legendary investor Jonathan Twombly. How you doing, sir?
I'm doing fine, Michael. I have to laugh every time you say that, but thank you. I'm legendary in your mind anyway. So
Yeah, it's my show. You're a legend in my mind. So yeah, there you go. Hey, one of the things we had to talk about is because we're both investors. That's essentially what we both are. And inflation came in hotter than expected. It's still on an upward trajectory. For those that don't know, it came in at 7.5%. This is CPI. Expectations were 7.2. I had an over under at 7.4. So that was my number, and it even exceeded that. And because of that, the 10-year spiked to over 2%. I called that as well on Monday. So I'm running pretty good on these numbers. But I wanted to talk to you. What does it all mean? Because it's an interesting soup we find ourselves in.
well, I mean, if hundreds of years of economic data still ring true in this era of Bitcoin, it means that money is going to start flowing back into more low risk assets because they're paying better interest rates, and the search for yield is over, right? Or it's
Right.
Search for yield is going to start, the tide will start going in the opposite direction when interest rates go up. So that means that risk assets are going to decline in value, basically. And since everything is now a risk asset because the Fed has pumped easy money into the system for such a long time, that essentially everything has become a risk asset, a speculative asset. That means we're going to be in for some interesting times over the next couple of years as interest rates rise and the market has to adjust to it. So
cost of money is going up.
Yeah, and that just affects everything, right? Well, it affects assets. Let's put it that way. Because the interesting thing is, so I've been reading, and we know we're going to talk about this later, but
Sure.
I'll jump in now. I've been reading The Lords of Easy Money, which is all about how the Fed, under Bernanke in the aftermath of the financial crisis, pumped the system full of money on the theory that this was going to help employment, which it didn't. But what it did was blow an enormous, bubble in pretty much every asset you can think of. Because when treasuries are at zero, that means that insurance companies and all these other places that have massive amounts of money that have to be invested, and they need to get some yield, but for them, 2-3% has always been sufficient. They had to go out and start buying riskier assets just to get 2-3% returns, right? And then just pushed all of the money sort of out the risk curve, right? But it did nothing to help with employment, really, because as with cheap money, companies bought their own stock back rather than investing it in factories and whatnot. So it didn't really do anything. So the question is actually, when the opposite happens, when the Fed sucks money out of the system, will it have any effect on jobs? Maybe it won't. But of course, Wall Street will scream and yell as their assets go down, and they will say, "Oh, you're going to hurt the little guy." That's going to be their justification for trying to pressure the Fed into lowering interest rates again. But I'm not really sure that it really makes a difference, given what those corporations and stuff use their easy money on, right? They didn't use it to build new factories and stuff. They used it to buy their own shares back and get big bonuses for themselves and stuff like that. So, we'll see what happens. It goes into reverse.
This really is unprecedented times, because I've been doing a lot of reading about Q4 2018.
Yeah.
If you don't know that period, folks, 2018 was the last time the Fed tried to shrink their balance sheet en masse. And they did it to the tune of about $500 million, 500 million. And it didn't end well, both for stocks and real estate. Now, real estate didn't fall in value, but transactions stopped.
Yeah.
And why is this important? Well, there's talk of the Fed reducing their balance sheet $2 trillion this year over the next 12 months. that sends shivers down my spine. So Jonathan, I want to read you something because I got asked, what do I think happened? So I just want to play these dominoes out and you let me know how they feel. All right.
Sure.
So, okay. So if they have to shrink their balance sheet, the first thing that, in my opinion, is going to happen, because they will become sellers, not buyers, is rates will go up. So I believe rates go up not only because they're raising rates, but because they're sellers, not buyers. So rates go up again. Borrowing will go down, right? What you would expect. When the cost of money goes up, it becomes harder to borrow and borrowing goes down. Now that's borrowing for new purchases and also borrowing for cash out refinances and things like that. So all borrowing goes down. Consumption gets hurt because, again, less money, less consumption. In the real estate game where I play, transactions go down. Makes sense so far? That will then ripple into the economy. The economy slows down. Consumers are buying less stuff. Real estate transactions, refinances, all of these things go down. So the economy gets hurt. And then hard assets like real estate could, if this goes on long enough and deep enough, also take a hit. I believe stock markets are hit actually kind of at step zero. The risky assets that are traded on moment's notice are hurt first. That's like step zero, probably starts happening pretty soon. But those are the dominoes I see, because I always get asked, is real estate going to crash? Well, maybe. There's a series of steps. Real estate is price inelastic. It is much, much slower. But if you play these dominoes out and they fall in successive orders, you could get there. Does that make sense?
Yeah, absolutely. And I think, as we've talked before many times on this podcast, that as the cost of capital goes up, it just reduces what you can pay for an asset, right?
Correct.
So, so that is going to have an effect. I know there are people who disagree with me, say, "Oh, no, investors will just pump up more equity to buy these assets at a lower LTV," but I don't see it happening, right? I don't see it happening. And cap rates will have to rise, because as interest rates go up, right? The only reason borrowing makes sense is if you have an interest rate that is lower than the cap rate, right?
Correct.
So,
correct.
right, like, I don't think I just confused myself. Interest rate lower than the cap rate. Yeah, because then you get positive leverage, right? Which means that the more leverage you have, the higher your returns to equity are. But if the opposite happens, if interest rates rise above the cap rate, then you have negative leverage. So every dollar you borrow actually reduces your return. So investors, unless you're in like a real, actual hyperinflated environment, right, where people are making the calculation that it is better to lose less than lose more, then you might see investment continue, but at the same cap rates, or even at negative leverage. But most people are going to say, I cannot pay this cap rate if this is what it costs me to borrow money. And the banks are certainly not going to lend as much money under those circumstances. They're going to require you to put up more equity. And we've already seen it happening. The other day, Arbor Capital went and just slashed its proceeds to a whole bunch of loans that were in process, right? So,
wow, say that again. This people need to hear these things. So this banks, people don't realize, I wrote about it in my book, banks could change overnight.
Yeah.
And what was safe suddenly isn't safe, and they will stop or adjust immediately.
If you were not rate locked already, and recently nobody's getting, when I started, everyone was getting rate locked like early in the process because they thought interest rates were going to go up or they were volatile, whatever. We've had low interest rates for such a long time that nobody has been worried about interest rates going up. So they've been rate locking, a day or two before the transaction, not a couple months before the transaction.
Yeah.
And now what we've seen is now, and related to the treasury going to 2, like you said, that's the baseline. See, I think what a lot of people don't understand about the way lending works is lending, especially for like commercial lending, banks are not saying, okay, we've got $100 million of cash in the bank and we're going to lend 10 million of that to you for your, on your deal. Mm-hmm. That may be the case at like community banks or whatever, they're on their balance sheet, but for big banks, that's not how they operate. What they're doing is literally executing a transaction where almost instantaneously they are buying treasuries,
Mhm.
right? And then they are, yeah, where they're, I don't know. I mean, I'm getting myself so confused, but the point is they're borrowing the money
Mhm.
from the public markets, or they're borrowing it from like wherever they borrow it from, the Fed or whatever, and they lock in a spread and then they lend it to you. So it's
Correct.
happening instantaneously. So they're not lending money that they have, they're lending money that they borrow.
Correct. But
So
they borrow at X, they add on their premium. That's how they make their
right,
spread.
exactly, that's the spread, right? So
Mhm.
they're borrowing at whatever the treasury rate is,
Uh-huh.
right? And then they are then locking in a spread, and they lend it to you at a different rate. You know, it's sort of like the old days when I used to say, like, what was it? The bankers is like, lend it, borrow at 3, lend at 6,
Yeah.
golf at 3, that
Yeah.
was
Yeah, exactly.
6,
Yeah.
3, right? And so, I mean, but they did it with their own money, right? They did it with deposits in those days. Now they do it with money that they're borrowing
Mhm.
from the Fed, or they're borrowing from another bank, or wherever it is. And so the point of this is that if that interest rate goes up that they're borrowing at, they have to pass it through. They'll
Correct.
absorb some of it, but they're not going to absorb that much of it, and only for so long. And
Yeah,
so
I think that's the key, because a lot of new people in this game will assume that banks will eat margin a little bit, which they will in a short window. But I've actually seen times where margins can expand. Right?
oh yeah,
These margin things that people are they're not always the same. Sometimes they're risky, sometimes they're not. And I've seen spreads. I think the biggest spread I saw, or growth in spread, was like 3/4 of a point, which in the interest rate world is huge.
oh yeah. No, I remember back in like 2013, 2014, 2015,
Yeah, exactly.
when the markets were still pretty skittish, and people forget that now, but the markets were still pretty skittish. The banks, the spreads were like all over the place. Like
Yeah,
I
exactly.
would do a deal, and the spread would be 175, and then the like 2 months later, my lender would say, "Oh, the spread has gone to 250."
Exactly.
And so,
Exactly.
the interest rate didn't change that they were borrowing at,
Yeah.
but their perception of risk had changed, and they wanted more of a premium to do lending. So that can happen. So I think that when interest rates go up a little bit, they will they will absorb some of it. But the thing is, they probably have a floor rate, a floor spread beyond which they won't go.
Correct.
So, and my guess is it's probably somewhere in the 125 to 150 basis point range.
I don't think I've seen anybody, even in the good old times, like 2004 and 5 was kind of the most loose lending I've ever seen. And yeah, I think the spreads were 1.25, I think.
So I don't think they're going to go much below that.
Oh, no, I don't think they get anywhere close to that. I think it's at least 1.5 now. I think that was bad lending back then.
They will pass that through, and that means that your cost of capital goes up, and that they're going to lend fewer proceeds. And so what's happened with Arbor right now is that a bunch of the deals are in process. See, if for deals going forward, they won't have to cut proceeds, because they're going to tell borrowers, like, this is how much money you can get, and the borrowers are going to negotiate with the sellers, right, on that basis. But for deals that were in process, like deals that are about to close, right, the price is not going anywhere. I mean, unless the buyer is able to go back to the seller and say, hey, we got to retrade. But it's still an extreme seller's market. And
yeah, not happening.
And so you have to, the banks are just saying, hey, we're just going to give you less money. Go raise it from your investors.
So here's a question for you. And again, people need to realize this. We've been doing this for a long time. I actually think there are some deals that were being celebrated in the last 45 days that yet haven't closed and weren't rate locked, that will blow up, that will get undone. Money that went hard will be lost. So I think there's some deals that were expected to close in the next 2 to 3 weeks that will never close, because I think cost of money has gone up. People weren't ready. They weren't prepared. And I think all of this is happening now, where investors, the LPs, are going to get skittish. Like, I gave you this, I'm not going to give you more, because it's going to be a very interesting time if deals haven't rate locked. Could deals blow up, you think?
Yeah, I think it could. I think especially for deals that are overpriced.
Yeah,
right?
exactly.
Things that are overpriced and people are paying. I mean, listen, like your interest rate is a huge function of your underwriting, right? And your
Absolutely.
projected returns.
Yeah.
It's your biggest, if you're doing a typical 75% LTV deal, your interest rate, not your interest rate, your borrowing costs, right? You're servicing your debt
Mhm.
is your single biggest expense.
Oh, without
right?
question. Yeah.
Right. So, obviously your operating expenses in total are going to be about 50%, but your debt service cost is going to be about 20 to 25% of your income. Right.
Yeah.
And so it's the single biggest cost you have. So if it gets bigger, that is like very quickly hits your bottom line. Right.
Yeah.
So
yeah, no doubt. I really do. There's again, the good thing is we've been talking about this for a while. Jonathan Twombly has his own playlist with well over 100 hours here. Go back and watch some. There are syndicators out there who have been preaching cap rates going to 2.5. I do not see that in an environment where the 10-year just hit 2.
Listen, there are various reasons why people say that. And I think some of it is because it serves their interest to do so.
Well, let's be very clear. There's only one reason. It is self-serving. It is a story they're telling because they are, they want to keep raising money. It's how they get paid.
Yeah, well, I also do think that a lot of people have bought into this hyperinflation narrative, right? And so they only think of one side of the equation, right?
Mhm.
They think, well, if we're in a strong inflation environment, people are going to want hard assets. They don't think about, well, what's the Fed going to do in reaction to that, and how is that going to affect real estate? It's usually, you talk with a lot of people, and a lot of syndicators remind me of the national the National Association of Realtors. Right?
Yeah, I remember. Yeah,
We're like,
back in 06. Yeah, I remember.
Yeah, interest rates go up. Oh, good for real estate.
Good for real estate.
Good for real estate.
Yeah, what are you talking about? Yeah.
Banks are going to give you less money. Good for real estate, right? Like, unemployment has risen. Good for real estate. It's fallen. Good for real estate. Like that's kind of how another Great Depression. Great for real estate.
Exactly.
We'll be able to buy it cheap. So
exactly.
It's sometimes it's the same thing. Like,
yeah,
it can never be bad. In some
I agree. Well, the closing thought on this, and then we'll get on to episode number 2. Do you think at this point a 50 basis point move in March is a lock?
I don't know. I can't.
I can never get you to play. That's okay.
It's just because I just don't know. I'm not as steeped in this issue as you are. So 50 basis points seems like a lot to me in one single move.
Okay, that's fair.
I
like it.
I would not be surprised if they go up 25. Okay, I'll play. Let's just. I think it's been unusual in the history of the Fed that they will raise a half point at once.
Okay.
I think they were going to try to do it
true.
a much more gingerly way, because they don't want to spook the markets at the same. And I think a 50 basis point rate hike would spook the markets. So I don't see that happening, even if inflation continues to print strong.
Yeah.
If the rate hikes don't rein it in, and they start getting skittish, I still don't see it yet. I think they will just continue to keep on raising in increments, rather than, doing a Paul Volcker. Because also, look, inflation is also not yet anyway at 1970s levels, right? So
you're very much in the camp of Goldman Sachs, which we will get to in episode number 2. I'm going to come out and say it one more time. This is now a lock at 50 basis points. Okay. They need to pull Paul Volcker. They need to save their reputation. They need to spook the market. They have now realized that asset prices across the risk assets that we talked about at the opening are overpriced, and they want to pop this. So I fully expect half a point, but in fairness, I've been saying the same thing for 4 months. So kind of a broken record. So Jonathan, how can people find you?
Well, many ways. One way is to go to multifamilylaunchpad.org, download my free giveaway there, and get on my email list. That free giveaway is called How to Buy Your First 100+ Unit Apartment Building with Other People's Money and Get Paid to Do It. You can also Google my company, Two Bridges Asset Management, LLC, and fill out the investor form to get on my investor list. And finally, you can also go to Multifamily Investment Community on Facebook and join my community there.
Very good. Thank you very much, Jonathan.
Absolutely.